Hey, I'm here with Jason Barley, Barley Mortgage in Mount Pleasant. Jason is an excellent mortgage banker, and we're fortunate to have him to answer some questions. And I'll first let Jason talk to you and tell you a little bit about him and his company.
Yeah, thanks, David. I appreciate you having me today. It's great to be here with your clients. I appreciate the opportunity. As you know, we're a small local lender here, right in Mount Pleasant. We loan throughout the Tri-County area. My team and I have been together for about 20 years now. I think combined we've got 85 years of lending experience and done over $1.5 billion here in the Tri-County area. So we feel like we've got a lot of experience, and we appreciate you having us on today.
Well, great. Well, thank you. And I guess the first question maybe you could tell people is, what affects mortgage rates?
Sure. And that's a great question. Generally in a normal market, you see things that affect mortgage rates like non-farm payrolls or people employment, income, consumer confidence, things like that are generally what impact mortgage rates. You want to see people having confidence, being employed, things like that, and then you can adjust mortgage rates from there. Lately this year, everybody seems to be focused on inflation, and rightfully so. So the biggest driver this year has been what's called CPI, or Consumer Price Index, and really you break that down to the month-over-month Consumer Price Index. What they're looking at there is they want to see inflation starting to get under control. I think once we start to see the inflationary things become under control, then we'll start to see a little bit more stability in the interest rates.
Okay, great. So tell me, what types of loans are out there?
Sure. So on the residential mortgage lending side of things, there's really three popular types of loans that you see. The three most popular types of loans you see are conventional loans, which we'll go a little bit deeper on. Then you'll have FHA loans, and then also VA loans. So kind of starting with the VA loan are geared towards service members. You'll see a lot of the veterans you have to be a veteran in order to apply for a VA loan. VA loans are excellent. They offer 100% financing. They're flexible on their income requirements, and also their credit score requirements. So any of the service members, the VA product's an excellent product for them. And then from there, you'll move into an FHA product. FHA products are great. FHA will allow for as little as 3.5% down. They're a little more flexible on their credit score requirements and their credit history requirements. And so FHA could be a great program for some people with a little less money down. The third and most popular type of loan product that you see on the residential side are called conventional products. And you'll hear about Fannie Mae and Freddie Mac. Those are the two agencies basically that set the underwriting criteria from an income, credit, asset standpoint. And you follow the agency guidelines on most of the conventional stuff. And they have great programs there as well. You could do as little as 3% down on those. That's where you see the most competitive interest rates in terms on conventional products and programs. And so really those are the three main types of programs we see when it comes to residential lending: FHA, VA, and conventional.
So what about mortgage insurance? What exactly does that do for the individual or the lender? Why is that in the transaction?
Sure. So mortgage insurance is going to be required on any residential type transaction where there's not at least a 20% down payment. There's several different forms of mortgage insurance that you see out there, but generally speaking, you will have mortgage insurance on anything less than 20% down. And what the mortgage insurance does is protects the lender in case of default on a loan. So you'll have different forms of mortgage insurance, whether it be a borrower paid monthly mortgage insurance, a single upfront premium mortgage insurance. There's several different ways that you can insure the loan from a mortgage insurance standpoint. But a mortgage insurance is required on any residential transaction that doesn't have at least a 20% down payment.
Does it ever go away?
Mortgage insurance does go away depending upon the type of mortgage insurance you have. The standard type of mortgage insurance that you see nowadays is called borrower paid monthly mortgage insurance. And that premium is basically paid into the loan monthly. And there are really three ways that you can drop the borrower paid monthly premiums after you've originated the loan. The first way is just through regular principal reduction. So as you're paying your loan down, set on your base amortization schedule, the mortgage insurance will eventually drop off the loan. What you see with 5% down, it may take 8 to 9 years for the mortgage insurance to drop off. With 10% down, you may be 6 years or so for the mortgage insurance to drop off. Mm-hmm. With 15% down, it's around 3 years. Mm-hmm. And then obviously mortgage insurance is not required at the 20% mark. But the first way is through regular amortization. The other two ways that you can drop mortgage insurance off is after you've owned the property for 2 years. If you feel like the property has appreciated enough in value to give you the equity, you can apply with a servicer at that point in time, get a new appraisal on the property, and depending upon the balance that you owe at that time, compared to the value at that time, mortgage insurance can be dropped off at that point in time. The third way, which is a little bit different way, is if you plan to do substantial improvements to the property after you purchase the house. And substantial improvements really is adding square footage. It's not just paint and some cosmetic type upgrades. It's substantial improvements. If you do substantial improvements in the house, you can apply to have the mortgage insurance dropped in less than 2 years, assuming that the value's in the property at that point in time.
Okay. Now, my understanding is FHA is a little different when it comes to that type of mortgage insurance.
You're exactly right. With FHA, there are 2 forms of mortgage insurance associated with the transaction. The first is an upfront monthly mortgage insurance, which is a factor of the loan amount. And then the second is a monthly premium. Whereas with FHA, currently FHA, the mortgage insurance is required for the life of the loan unless you're making a 10% down payment. So FHA is a little bit different than conventional mortgage insurances.
Okay, good. So,
Good clarification there.
yeah, so can you prepay loans or?
You can prepay loans. What you'll do is within your disclosure information, there should be no prepayment penalty on the loan. Eventually, you're going to get what's called a loan estimate from your lender. And on the first page of that loan estimate, there's a box on it. And you should make sure that box is checked. There's no prepayment penalty associated with the loan. That way you can prepay the loan monthly, annually, pay it all off in full. But there should not be a prepayment penalty associated with most loans.
Okay. So what is the best way to compare lender rates? So
Sure.
I guess you got 2 parts. You got the rate and you got the fees, right?
Correct.
How do you, from a borrower standpoint, it's kind of daunting trying to figure
Correct.
out what rate versus fees versus et cetera.
You're exactly right. It can be a very overwhelming process a lot of times because you only buy a few houses in your life. So what you'll want to do is you'll ask each lender for a itemized fee worksheet. It used to be called a good faith estimate. If you've already applied for a loan with them, it might be called a loan estimate. But really what you're asking them for is an itemization of fees. And what that itemization should do is it should break down your cash to close and then also the corresponding monthly payment associated with how much you're going to borrow and the corresponding interest rate. Once you have that itemized fee worksheet, then you can dig a little bit deeper in there and kind of get to the bottom of what the true lender fees are. Because as David mentioned, there are other fees that are non-lender related fees that are going to be on an itemization. For example, the attorney's fees, some estimated prepaid items or escrowed items, which would be taxes and insurances. So when you're truly comparing a loan estimate based on the lender fees, you want to break down what your lender fees associated with a transaction are compared to the interest rate that they're giving you for those costs. And then once you get the loan estimate or the itemization of fees, it should become very transparent for you.
Oh, great. That's awesome. Last question, and this is the hard one, and this is kind of alt market we're in. When should you lock into your interest rate?
Sure. Well, what we advise after 23 years of experience and just been the best method for us is we always advise the consumer to lock in once they go to contract. Up until that point, you've had conversations with a lender. You should know kind of what your basic costs are, a roundabout idea of what the interest rates are going to be when you're looking at the property. But once you go to contract, we advise that you lock into the interest rate. Basically, what you're doing is you're putting a ceiling against any market fluctuations or any increases that you can see over that 30 to 45 day process that you're going through your due diligence and processing the loan. So we advise that you lock in at contract, at ratification, but then confirm the 2 things once you lock in. And the first is, like we talked about earlier, and it should be outlined on your loan estimate, on page 1 of the loan estimate, that there's no prepayment penalty associated with the loan, that you can refinance that loan down the road, you can make additional payments to principal down the road. So you want to confirm first that there's no prepayment penalty on the loan once you lock. And then the second thing you want to do is confirm that there's some kind of a float down feature on the loan, which with our programs, we have a float down option on the loan, which basically says we're going to place a ceiling on the loan once you go to contract, once you ratify your contract. It's going to take 30 to 45 days to do your appraisal, to get your inspections in, to do the underwriting of the loan. And then once we get closer to closing, if market rates are less than your lock rate, then you can go in there and exercise a float down option. We literally had one of those yesterday where the consumer is extremely volatile market with interest rates nowadays. Consumer went to closing. We processed loan over 30 to 45 days. Rates have come down here recently. And on a $500,000 or $600,000 loan, she saved about 0.75% in interest rate, which equates to about $275 to $300 a month in savings.
Wow.
So we were able to save them thousands of dollars over the life of the loan with our float down option policy.
Right. Well, Jason, thank you very much for being here, talking about the mortgage and some of the things that are confusing to our clients. And thank you for always doing a good job for my clients as well.
Absolutely. I appreciate the opportunity, and we really appreciate working with you.
All right. Great. Thanks.
Thank you.